In the 1950s, a guy named Harry Markowitz figured something out that changed the way smart people invest even today. He showed that if you combine different kinds of assets, ones that don't always move together, you can actually reduce your overall risk without reducing your returns. This idea became the foundation of what is called the modern portfolio theory, and it is still the basic principle behind how every serious investor, every pension fund, and every endowment builds their portfolio. It is not about finding the perfect stock, it is about building the right mix. And that is what we are going to talk about today. I'll show you how to construct a smart, sensible portfolio, how to diversify properly, when to buy, when to hold, when to sell, how to balance equity and debt depending on your stage of life, and even how to track if you are actually beating the market. We'll keep it simple, relatable, and I'll throw in plenty of real world examples. Defensive stocks, dividend stocks, cyclical stocks, so you can really see how portfolios behave over time. And before we dive deeper, if you're new here, hit that subscribe button and join our Telegram group. We have some amazing conversations there, and all the links are in the description below. Alright, let's get into it. Think about how venture capitalists invest. They don't throw all their money into one startup and hope that it becomes the next Google. They invest in a bunch of companies, knowing that some will fail, some will survive, and a few will hit big. That is exactly how you should think about your portfolio too. It is not about getting every pick right. It is about making sure that your winners outgrow your losers over time. Now, the first big building block, diversification. And I don't mean buying 25 random stocks. I mean owning different kinds of businesses that react differently to the world around them. Think of it like building a cricket team. You need reliable openers, companies like Hindustan Unilever or ITC, the so-called defensive stocks that perform even when the economy slows down. You need middle order stability, dividend paying stocks like Coal India or Power Grid that give you a steady cash flow. And you need the finishers, cyclical companies like Tata Steel or Bajaj Auto that explode when the economy is booming but can slow down sharply in bad times. If you build a team of only one type of player, you will struggle. Same with your investments. Now, how much should you concentrate on your best ideas? If you've done real research and your conviction is rock solid, it is okay to concentrate a bit. But don't go all in. For most people, a portfolio of 15 to 20 good, different stocks is a sweet spot. Enough to protect you, but still focus enough to matter. Now, when do you buy? When do you add? And when do you just hold on? Well, you buy when the price you're paying makes sense compared to the long term value you expect the business to create. You add more when your conviction gets stronger, like after strong results, better execution, or a positive shift in the industry. And you hold when the story has not changed, even if the stock price is bouncing. Selling? Now that's a big decision. You sell when the fundamentals go bad, the valuation becomes totally disconnected from reality, or you find a significantly better opportunity for your money. Now, this ties into value investing. Value investing is not about buying anything that looks cheap. It is about buying good businesses when they are ignored or underappreciated. Like when manufacturing exporters or mid cap IT companies fell out of favor recently, even though the businesses themselves stayed strong. That is where real value often hides, when the crowd is busy chasing shiny objects elsewhere. Now, beyond just picking stocks, you also have to think about balancing equity and debt based on where you are in life. If you're in your 20s or 30s, you can be aggressive and allocate 80 to 90% to equity because you have time to ride out market cycles. In your 40s, you start dialing it down, maybe 60-70% equity, and rest into safer debt instruments. And in your 50s and beyond, capital preservation becomes key. 50-50 between equity and debt is a good starting point depending on your goals. Remember, short-term money, anything that you need in the next 3 years, should never be parked in stocks. Now let's say you build your portfolio. How do you know if you're actually doing better than the market? Now this is where beta and alpha come in. Beta tells you how much your portfolio moves compared to the market. A beta of 1 means that it moves exactly with the market. Higher beta means more swing and more risk. Lower beta means more stability. Alpha is the extra return you generate over and above the market after adjusting the risk you took. So say Nifty generated 14% in the last 1 year. If you generated more than that, then you have an alpha. Consistently delivering positive alpha is the real mark of smart investing. But how do you track your portfolio performance properly? Well, the easiest way is doing XIRR in Excel. XIRR is a formula that accounts for all your cash flows, when you invested, when you added, or when you took out, and gives you the true annualized return that you're earning. It's a simple formula, No guesswork, no relying on random portfolio screenshots, but real math. And finally, a quick note on tracking company results. Don't just get swayed by the headline profit numbers. Look at revenue growth, check operating margins, and see if cash flow is strong. Because sometimes companies show profit on paper but no cash in the bank. Watch debt levels carefully and listen to what the management has to say. Are they cautious, sensible, or are they over promising things that sound too good to be true? Also, red flags like receivables piling up, auditors resigning, or frequent equity dilution are not good. At the end of the day, building a winning portfolio is not about genius stock picking or timing the market perfectly. It is about stacking small, smart decisions one after another and letting time and compounding do the real work. If you found this video helpful, hit that subscribe button and join our Telegram group if you want to hang out with other serious investors who are learning and building alongside you. Link is in the description.